Hello, everyone. Hope you and your loved ones are safe and healthy. For this edition, we have also been joined by our fund management team experts, our economist, Mr. Bhupesh Bhameta, and our fund manager, Harshal Suvankar. Welcome, Bhupesh, and welcome, Harshal. To set the context for this edition, of late the commodity prices have been falling inflation, and we thought this is a good time to quickly share our views from the experts on the same. Just to start with, Harshal, commodity markets are seeing a bull run after a lull that we saw last year, right? What's in store ahead, and what do you think, or how do we read into this move going ahead? Could you please share your some insights on this?
Sure, Nayan. So, Nayan, I think you can see my slides. So, essentially, from a commodity perspective, we've seen broad-based increase in base metal prices. We've also seen food price index going up. Food price index has largely went up because of oils and fats, piece of the so edible oils going up over there. So we are seeing, if we go back to the basics, this pandemic is different from what we would see generally in a recession. So during a recessionary phase, we only see a demand shock. But during the pandemic or a natural disaster, howsoever you term it, we've seen that we've also had a supply shock as well as a demand shock. So while supply has not been able to pick up because of various reasons, lockdowns and global supply chains getting disrupted, and you seeing demand increasing because of the pent up demand, largely because of fiscal stimulus is given, and consumer demand. We have also have vaccine rollouts happening very aggressively. So the demand has shot up while supply has not been able to catch up. And because we've not seen these demand supply dynamics in the past, although it's very hard to predict as to what happens, but largely right now what we are seeing is because of the changed demand supply dynamics is causing commodity prices to increase. So like for example, copper is increasing. So copper production was disrupted during the lockdown. We've also had under investment in copper investment in the past by miners. So which is also causing the supply constraints, whereas demand has increased because of large infrastructure funds which are happening by the governments, and the pent up demand that we are seeing, which is why copper prices are increasing. Similarly, export producing countries were not able to produce more oil, which is why you are seeing oil prices, edible oil prices increasing. So it's a kind of a peculiar scenario which is happening. So essentially, this is why we are seeing commodity prices increasing right now.
Harshal, that's quite interesting and detailed. Just as a follow-up question to that, we saw elevated inflation prints from the US yesterday, right? Uh, so is this a start of a higher inflationary cycle? That's the first leg of this question. And how do we see Fed reacting to this inflation prints?
Sure. So what we are seeing in the US print right now is that some of the items like used cars has stoked inflation higher, which is because of the supply issues which we are seeing in the semiconductor chips, which is causing car productions to get stalled. So which is why used car demand has went up, which is not being able to pick up with supply. So while some items have stoked inflation higher over there, if we were to look at the Cleveland Fed core CPI measure, which removes these extreme price moves, you will see that how the inflation is lower excluding these few items. So right now it doesn't look broad based that these spikes which we are seeing, but going forward in the next 2-3 months we might see that this spikes become broad based given the supply demand dynamics. But by the end of calendar year 21, when supply demand dynamics come to an equilibrium, we will see that inflation normalizes, and by calendar year 22 it can resume its downward trajectory towards the 2.5-3% kind of range. From your second part of the question as to how Fed will react to it, all the monetary and fiscal measures that we've seen is to stoke higher inflation, uh, uh, giving us growth, and also helping on the unemployment side, which has been caused by the pandemic. So, and they have moved to average inflation targeting regime. Earlier, they've always been lower than 2%, whilst they have tried to stoke it higher. So this time they have moved to average inflation targeting regime, which will mean that Fed will not react to these prints, which will allow inflation to remain about the 2% target range for some time before they start reacting to these prints. So as of now, we should not read too much in these prints and see how inflation goes ahead. Plus, also, there's been a lot of debate on how money stock increase or has stock inflation, but we should also pay heed to velocity of money, which is how inflation is derived by multiplying velocity by the money stock. So essentially, we've seen velocity of money also declining along with the increase in money stock. And only when this velocity increases, so we should keep a close watch on velocity, which will come back when demand increases in the economy back to the pre-pandemic levels, which is when we might see some inflationary pressures building in.
Harshal, that's quite detailed and informative. Just want to, bring in Bhupesh there, who's been quietly churning a lot of numbers on the Indian side as well. So, Bhupesh, just to take forward from what Harshal, detailed about, uh, with this current hike or rise in commodity or food prices, do you think this will percolate into India's inflation print as well?
Thanks, Nayan. So, to begin the answer, let's first look into how India's inflation basket is, and how what have been the segment which has been driving the Indian inflation over the past 7-8 years. The key point to note, number one, is that like a typical EM, India's inflation basket is very heavy on food inflation, which has around 45% weightage on India's CPI basket. That is typical of what we see in other EMs also, which are where in most EMs we see that food inflation is a bigger part of the overall inflation basket. If you look into the past few years, past 7-8 years, what we see is that not only is India's inflation dominated by food inflation, the second point to note is that food inflation is also very volatile. So the two combined means that whatever happens in food inflation is the key determinant of what happens to the overall headline inflation. If you look into how India's inflation has moved with the commodity prices, what we see is that both with WPI, India's wholesale price index, and also with CPI, India's consumer price index, what we see is that the CRP is basically the global commodity prices index. And what we see is that it has a very high, the CRP index has a very high correlation both with WPI as well as with CPI. Of course, the correlation is more with WPI because WPI is more dominated by metals and commodities. But even with CPI, if you look into here, it's quite statistically significant, and the coefficient is also pretty decent. Now that was about the overall commodity prices. Now, if you look into food prices in particular, what we see is that even with food prices, India's CPI food has a decent correlation with the global food prices. And RBI has in this paper in which they analyze what is the pass-through impact of global food prices on India's inflation, India's food inflation, and they find that while on a very near-term, short-term basis, the impact is quite low. The elasticity is quite low. If you look into long-term elasticity, it is pretty significant at around 0.3, which means that for every 10% rise in global food prices, it will translate into a 3% rise in India's food inflation as well, though with some time lag. So net, what I mean to say is that global commodity prices and particularly global food prices have a bearing on India's inflation as well. Now, how do they have an impact? What are the channels through which they have an impact? They are basically three main channels. First one is the imports channel. It is more relevant in those items where we have a deficient supply and where we are net importers. Typical would be vegetable oils and also pulses. The second channel is export channel, where it is significant in items like rice and marine products, meat products, and also where we are a big exporter. The typical way would be that whenever global prices are up, our exporters will start selling outside India, and that will have an impact on domestic food prices as well. And both these channels are quite important. The third important channel, which people typically tend to overlook, is the MSP channel. What happens is that whenever government is setting the minimum support prices for food crops, what they look into is what is the global food prices. So one of the factors which they look into when determining what will be the MSP for India is the global food prices. So these three things combined results in what we have seen earlier, that global commodity prices does have an impact on India's inflation.
Well, Bhupesh, that was quite detailed, and a lot of charts and data supporting your rationale on that. Lastly, just to take your inputs on how do we see inflation trending in Indian context?
Yeah. So basically, inflation, we have different segments and there are different forces in inflation. There are some upside risk to inflation that we see. We also see some downside risk to inflation. First, look into what RBI is saying. So the RBI forecast for inflation over the next 4 quarters is of an average inflation of around 5%. If you look into what professional forecasters are forecasting, they do a survey of these professional forecasters. We see that most of them also have this benign outlook of inflation. Now, what our sense is that there are certain upside risks to inflation, there are certain downside risks. The key upside risk would be what we discussed right now, the global commodity prices, food, crude prices, metal prices, all are trading significantly higher, as Harshit has discussed. Second, I think upside risk would be the supply disruption that we had because of pandemic. So in the first wave of pandemic last year, what we saw was that because of the supply disruption, we did have a big spike in inflation during this pandemic time. Now, same thing can happen this time also, but what we note is that the level of transport restriction this time is much lower. So we believe that this risk, while there, won't be that significant. The third point to note is that over the last few years, and especially over the last 1 year, we have seen record output in India's agricultural production, and which means that we are having a abundant agricultural products in the economy. Therefore, that will be one factor which will allow government to prevent the global food price inflation to come into India in a big way. So that's one saving grace for India. And the fourth downside risk to inflation is that the local demand conditions because of pandemics are quite weak. So net, two forces pushing up inflation, two forces pushing down inflation. We broadly agree with RBI's forecast. While we see that there is some upside risk to these numbers, our sense is that RBI has this 2 to 6% inflation target zone. And while there is some possibility that for some time at least for some months, this number can go higher than what RBI is forecasting, we believe that the numbers will remain mostly within their inflation targeting zone, which is 2%, which means that growth will remain the priority for RBI, and they will keep supporting growth to the extent possible, while overlooking if there is some temporary spike in inflation.
That's quite detailed from your side, Bhupesh. And I think this broadly covers this edition where we wanted to address, the rising concerns in the investor community on inflation perspective. Thank you, Bhupesh. Thank you, Harshil, for sharing your expert views on that. And hope we have been able to add valuable insights for our viewers as well. Thank you all viewers. Please take care and stay safe.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.